Well, aside from facing a hostile government at home, Australian miners will now have to grapple with the prospect of lower growth in their main export market, China. The Chinese government opened the National People's Congress with a warning that growth will slow this year to 7.5%, which would be the weakest rate in 8 years. Neil Woolrich reports.
It's the major set piece in China's political and economic calendar. And this year's National People's Congress has the potential to send shudders through already nervous markets, with Premier Wen Jiabao now forecasting China's economy will grow at 7.5% in 2012.
It's actually a marked downward revision to the growth outlook for China. And it's important to remember too that if it's realised, the 7.5% would actually be one of the weakest growth performances in China since 2004.
And they're making their comments that they need that rate to be sustainable. And that's really what I think China's looking for over the next 5 to 10 years, is sustainable growth that sort of doesn't lead to any sort of adverse domestic situation.
In another worrying sign for Australia's mineral exporters, China will now focus more on domestic consumption to drive its economy.
The industrial transformation and upgrading in the east has sped up, and the rate of urbanisation has exceeded 50%. This is a historical change to China's social structure.
So it's not so much about the rate, it's just the changing composition. So they're talking about moving away from investment and export to sort of more internal consumption. So if that was to lead to a lowering in their growth of consumption of iron ore and steel, then there could be some issues for Australia down the track.
Despite some investor concerns, reaction to China's move was muted, with Asian stocks and the Australian dollar drifting lower in the hours after Wen Jiabao's address.
In the short term, we don't really see a material impact. I mean, markets might sort of gyrate over the next couple of days, and I don't think it will be seen as a surprise, because everyone knows over the longer term Chinese GDP could not grow at 10% forever.
Economist Stephen Koukoulas says on its own China's growth downgrade won't be too disconcerting for Treasury or the RBA, given the stronger signs from the US economy recently.
If we get further downward revisions to Chinese growth outlook and we get weakness in other parts of the world, it is a big issue for Australia. We're very dependent on the global economy, and any further weakness would have implications not only for how the government might be framing its budget in a couple of months' time, but also for RBA interest rates.
However, Equity Trustees Head of Private Clients Sean Manuel remains confident in China's longer-term story and is sceptical of talk that China has a property bubble that's set to burst.
But I think the big numbers are that there's still, over 200 million people that sit below the poverty line. China are working very hard to get that group of people above the poverty line, which means that there's going to have to be a lot more investment over the next 20 to 30 years in social infrastructure. That includes housing.
A bigger concern for Australia's iron ore producers might be on the supply side, though, with new production set to arrive in the next few years and potentially drive prices and Australia's national income much lower than recent elevated levels.